Hello, everybody. Good evening. My name is Daniel Young. I am the owner and founder of Adaptive Perspective and the Adaptive Perspective social media platforms. And I am back to talk about our stock market investment strategy using closed-end funds. So, to get the normal disclaimers out of the way, this is an unedited video. Who knows what you'll hear in the background as I film these in my house. I'm not a financial advisor. I am a strategist and a financial strategist. And I don't speak like the herd. I try not to quite honestly, I try to talk unfiltered, but I don't speak like the herd. I walk in limited company, and sometimes I walk alone. So, where to start? Um, I started the Substack as I showed last week, but there's still pretty much everything to do. It's learning a brand new. It's Substack in and of itself is not a brand new platform, but it's brand new to me. So it's learning a brand new platform, and you can look for my page. I mean, it uses the same handle at Adaptive Perspective, but so far it's just a single page. I haven't made a single post yet, um, and I think that's because the lack of deadline, coupled with the start of the school year, has just turned me into a procrastinator of sorts. And I need to fix that. I mean, the best way to solve that lethargy is to act. But I also think part of it stems from not posting every day. When I initially started out, I was posting to too many social media platforms. Then I streamlined it and I focused on Facebook and I focused on these videos. And I would post daily in Facebook and I could schedule them out. I completely admit to pre-posting content. Um, so I would schedule out posts like 3 weeks, 4 weeks in advance. I would have general financial, uh, I don't know, like strategy session videos every Thursday. I would make closed end fund, or I would make financial literacy videos on Wednesday, and then I would make this video on Saturday or Sunday. And it got to be a lot. So I cut out the Wednesday videos, and then I cut out the Thursday videos because life got crazy. And then I kind of lost, I won't say I lost the narrative, it's just, or lost my way. I was trying to figure out the best way to do things and trying to streamline content to where it didn't seem all over the place. And in putting a strategy together based on what we were doing, I end in going through all of that stuff really helped me write the 12 steps to financial freedom. And then it became, how do I integrate the content and how do I really streamline it? Because Facebook is great, but managing a business page and two group pages is a ton of work. Um, Facebook on the personal end of things is easy and straightforward. Facebook on the business end of things is a fucking nightmare. Um, and it got to be challenging. I started a scholarship page on getting free money into college and then integrating that into a financial strategy series and then integrating that into the stock market. And it's just, I couldn't figure it out. So I kind of stalled out on Facebook. I still consistently met weekly to make these videos because honestly, at the forefront of everything was figuring out a way to monetize our closed-end fund master spreadsheet and also in pairing that with helping people realize that there's a better way to invest than all that traditional mumbo jumbo. So I like what Substack offers in the sense that it seems like I can put everything on the same platform. And I mean, I can section out the closed-end fund stuff, the CEF stuff, uh, from the main 12 steps to financial freedom. But at the same time, I can still like I can build an umbrella or reverse like a descending staircase system all on the same place that seems to interweave. So we'll see. but it's a lot of info. And that's kind of what it's really what I finally realized on Facebook. It's really hard to interweave it on a single page. It's also the fact that daily posting is a huge commitment. Whether you schedule it out a month in advance or not, daily posting on the steps of financial freedom and the strategy and the mindset and like breakout sessions essentially takes a lot of work and time and effort. And since I haven't been daily posting, I've taken on a lot of other responsibilities and goings on, and I haven't quite wrapped my head around how I'm going to get through it all if I start daily posting again. So I don't know. I have the Substack. The goal is to build it out. I would honestly try to pre-build it out, like start the financial freedom stuff, but schedule them to post. I think I can schedule them to post starting like September 1st, because that gives me a deadline, and schedule them out as far as I can. And then on the back end of things, I could come in maybe and post these videos and post these strategy sessions. In hindsight, on the closed-end fund side of things, it's just figuring out the system. So I have work to do on my end, and I need the headspace and the time to figure it out. And I'm short of both of those right now. But life will get better on my end of things. The school year will normalize. I will get more headspace. I'll get my head wrapped around things, my brain wrapped around things, and I'll figure it out. So once I have a good update, I'll update you. And either way, even if I'm stalled out for the next 3 weeks, I will still update you. But the goal is to create a closed-end fund platform on Substack underneath the 12 steps to financial freedom, or inside that system, and then have get and then be able to offer videos on how to create your own spreadsheet, like how to create a portfolio spreadsheet, how to make a dividend spreadsheet, how to get those two spreadsheets to communicate. Uh, give you a file essentially of every, yeah, give you the closed-end fund master, or at least present the closed-end fund master and update it weekly for you to download. I mean, that would be the goal. Uh, and lost my train of thought a little bit, but in being forthcoming, there we go, and being forthcoming with everything, there would be some type of paywall, because my goal originally was to monetize the data. I love data. I love helping. I love teaching. I love sharing. But at the end of the day, it takes a lot of work to maintain. I maintain it for me. I share it to help y'all. But yeah, there's going to be some kind of fee. I don't know what that is yet, to be honest. I have more research to do on that. Uh, but yeah, there would be a cost. I have no idea what it is. Uh, but at the same time, in right in writing the 12 steps to financial freedom and listening to a lot of other both content expert and system expert and financial people, I have zero desire to gouge people on pricing. Uh, I was initially advised to offer like 6 month strategy sessions for financial freedom purposes at 3 grand. And I pushed back against that. Quite honestly, if you're struggling financially, it's really hard. Personally, like if I'm struggling financially, it's really hard, really like next, like it's not going to happen. Like it's a snowball's chance in hell that I'm going to commit 3 grand for 6 months or $500 a month to any effort when I am struggling financially. And on the business side of things, for me, I find that egregiously wrong. I find that unethical and immoral to gouge people on pricing who are struggling financially. So I have to work out that I've got to work out the price of a book, and then I have to work out the price if there is a price for that system. And on the closed-end fund side of things, I mean, I know a guy who charges I think $800 a year for his service, which doesn't seem like a lot of money in the grand scheme of things, but that is a lot of money. Payment plan or not, that's a lot of money. And I have a hard time with that too. So I don't know what I'm going to end up doing, but at the same time, it's not going to be that. Um, so bear with me. That's really my only request. Bear with me. Give me some grace. I will get things figured out, and then when I have a good update, I'll post it. And in the meantime, I'll share all the other stuff, but everywhere in between of what I think about stuff. So getting to the market, uh, the markets are shifting, quite honestly, and they're shifting around in spite of the Federal Reserve's negligence to respond to the data. Uh, and I'll get back to that comment. But this week, monetary policy experts are supposed to meet in Kansas between Wednesday and Friday, 8/21, 8/23, to chat about the not the micro, the macro markets. But let's be honest, they're going to say they chatted about the macro markets, like the ultimate, it's like the top of the umbrella market, right? The giant market that spans the world. But at this point, I hope we can all agree that they're talking about control. The Federal Reserve has proven that we don't need them. They fuck things up and then get tasked to fix the fuck up. No other place does this work outside of government. And at work, like in mass, Elon Musk says it best, the government is the DMV in mass or beyond scale. And no place is that more true, I guess. No place is that more true than the Federal Reserve and the IRS. But really, the Federal Reserve takes the cake. The Fed has said since COVID on all of that nonsense, they said they don't understand supply and demand. They said they don't understand how they caused inflation. And yet, they're the ones who've been tasked with fixing inflation. Makes no sense. They say they're supposed to be reactionary, yet they are instigators. They're supposed to respond to data, not control the narrative or frontline the data. And the Fed has rendered themselves useless. Despite needlessly high interest rates, the economy chugs along and is gaining ground. Inflation is down, job numbers are up. And yes, I get the jobs report and all the numbers report uh, is in upheaval because somebody was falsifying the data. That'll get fixed. But inflation is down, job numbers are up. And if you recall, last week we talked about economics 101, 102, and 103. There is a 104, but economics 101, cut taxes, done. 102, lower rates. That should have been done 6 months ago. 103, increase oil production. So we've started with more contracts being approved by the day, and AI will ramp that up faster than the last time President Trump was in office. And if the Fed would do their self-mandated job, then the Trump administration's policies would jailbreak the economy. And I've said jailbreak before, and I don't mean like a prison break. What does jailbreak mean? If you jailbreak a device, you're removing software restrictions that are imposed by the manufacturer to either gain access or install unauthorized software or make it more efficient. Jailbreaking the economy would take the Fed's reins off interest rates and increase everyone's ability to afford everything. Why not make life more affordable? Well, the Fed likes control. So why is the Fed waiting to lower rates, knowing that if they drop rates right before the election? And I'll go back. So right before the election, in a very similar, well, let's say similar, the economy was struggling on life support. Inflation was high, and the Fed randomly cut the rate. Why? To make the sitting party look good. Since then, taxes have been cut, inflation is crazy down, the job numbers are strong, and rates are still super high. That makes no sense unless you understand that the Fed is all about control. The Fed is supposed to be reactionary. They're supposed to take data, sift the data, and react. And the Fed has gotten too used to dictating policy in spite of the data. And I think, honestly, me personally, I think they'd much rather dictate policy and doctor the data to make their policy seem more palatable and more realistic. So that meeting in Kansas is not about monetary policy. It's about how to control economies, because all of those people have realized that with a powerful US economy and a combination of their own actions and ambitions have rendered them all obsolete. The US housing market has already priced in a rate cut. The current national average is close to 6.6%. That's dropped almost a quarter of percent without a Fed rate cut, which doesn't really make sense, to be honest. I think it's hopeful speculation toward the Fed cutting rates in September. But the question becomes, will the rate drop further if there's a rate cut in December? Secretary Bessent commented on the data, said the Fed could easily lower rates 1.5%. And that would bring your current 6.6 new mortgage down close to 4%. And that's what we need. The short-term rate influences everything. Lower that and everyone gets everything cheaper. The problem in the real estate market is the demand. The macro data says that home prices are up 2%, right, to an average price of 396 or 396,000. But inventory is slowing. And theoretically, slow inventory equals competition, but the demand is still low. In my neck of the woods in Southeast Texas, our property value as proposed by the property tax districts are up big time. But on that, while I and a ton of other people hate property taxes, it's taxed into your death, right? In a sense, the property's never yours. And that's a completely different chat than just the stock market. But the property tax district's purpose is to raise funds. So they're going to raise funds as much as possible every given year within the law. And I disagree with that. But that's the law we're facing in Texas. I don't know what it is in your neck of the woods. So in my area, there are lots more homes on the market. There's a ton of homes on the market. It's ballooned since the end of the school year. But those homes aren't moving. My neighborhood alone has 3 to 5 houses that have been on the market an easy 9 months. If the competition was fierce, more houses would be moving faster. We'd see more houses being sold, right? Or more houses having that sign out front that says for sale with that new inked-in sign sold. But we haven't seen that yet because of the stiff interest rates. But if you drop the interest rates close to 4%, the real estate market space will go nuts. More on the rates. Odds makers are now projecting a rate cut in September. But why? Well, I would say why September, but I answered that several months ago. I answered that really in April and May. If you think of the Fed, so if you think of the Fed as this reactionary group that's doing the best for economy, you would be like every pundit on the news. But I'm encouraging you to think a little differently. I'm encouraging you to think independently. You have to think of the Fed like the guy or gal who's been in Congress way too long. Think of the Federal Reserve as an egomaniacal narcissist. They want the spotlight and they seek to manipulate and anticipate all angles of control. Why cut rates? Now, this is rhetorical in the sense of you're looking at it from the perspective of an egomaniacal narcissist. Why cut rates when most of the country is out for summer? And it's hard to see the cyclical nature of things based on the school year because not everybody's job is based on the cyclical school year, but a lot of the country is. When kids are home for summer, parents are doing other stuff. You have this giant population or subpopulation of the United States concerned with family stuff, and they're not really plugged into the news. Now, it would help everybody, honestly, help everybody if they were more aware than just the news. But that's neither here nor there. Maybe it's related, but not here nor there on this conversation. People pay attention to interest rates and all that when they're trying to move in February, March, April, May. But now that summer hits, they're not really paying attention to all that other stuff. The Fed wants the spotlight. They want everybody paying attention. So should they change things when everybody's not paying attention? No. They'll wait until August or September when more people have returned from summer vacations and are back on the school schedule. They want they both want to manipulate your perception and they want the ability to predict and control your perception. That's a master manipulator. Somebody who can manipulate how you think, that's one thing, but somebody else who can truly anticipate your reactions based on individual occurrences and correctly predict what you'll do next, that is a master manipulator. And that is exactly the Fed and their egomaniacal narcissistic behavior. So now that everybody's back and more people are paying attention, right? Now that more people are aware of hurricane season, right? Everybody's paying attention to that. So everybody's plugged into the news, or most everybody. I get my news on Telegram. So now that everybody's paying attention to the news, guess what? The Fed will make a monetary decision. And either this month, probably not this month because they have that big meeting this week, or next month, they'll finally cut rates 8 months behind schedule. In the market as a whole, so the Fed exists, but the market as a whole, regardless of the current issues, the market looks forward like a stumbling toddler careening toward the next shiny object. Sometimes it stumbles, sometimes it gets a boo-boo, sometimes it gets ahead of itself, sometimes it just keeps going. And as much as we all, in a very dark humor sense, want to see somebody else's kid just tank, we don't want our economy to tank. You can't be like, no, I don't watch that stuff. Everybody looks at the wreck on the side of the road. Maybe you don't, but you get the intel from your passenger because you can't take your eyes off the steering wheel because the guy's in front of you slamming on his brakes to take a look. I get it. But we don't want the economy to dip. That said, when it dips, that's the best time to buy. But the market itself was flat last week. Pretty neutral start to end. But if you listen to the analysts, you'll hear much the same. The market finished the week with small gains as hope builds in the Russia-Ukraine war peace treaty deal. But despite the hope, which I believe has more probability than the pundit hopes, the market is careening forward and onward, regardless of peace and whatever the Fed does. So the Fed can exist, the Fed can hope for control, the Fed can do whatever it wants. And currently, the economy chugs forward. So if the Fed wants to stay relevant, which they do because they are an egomaniacal, I want the spotlight narcissist. If the Fed wants to stay relevant, they will cut rates. Otherwise, the easiest way to nullify the Fed is to move us back onto a gold or silver standard. Currently, our monetary policy of the US dollar as currency is backed by the idea that the US dollar is currency. So a dollar is only worth as much as its perceived value of a dollar. So when inflation goes up, it devalues the worth of a single dollar. And like Kiyosaki says, your dollar is worth less, and the Fed is making your dollar worthless. Two words, similar meaning. But if you put us back on a fixed currency, it could be $1,000 equals 1 ounce of gold. Now there's a set value based on a fixed object. It's not the perceived value of money. It is this much. That's a very different standard of currency. But if we wanted to just get rid of the Fed, I mean, it would take an act of Congress. But if we wanted to get rid of the Fed, just put us back on a standard, Fed not needed. So outside of that debate, so we still got the Fed, we still have short-term rates. I think we ought to go back to a gold or silver. I mean, honestly, anything at this point, gold or silver currency, but I would take brass, copper, or lead. Just something other than I think the dollar is worth this much. And regardless of what the Fed does, right? All of that, like all of that to the side, the US is currently taking in billions in tariff money. And that's important. And I'll show how it kind of relates. But the US is taking in billions in tariff money. Current projection has the United States taking in over 2 trillion in tariffs by the end of 2025. Currently, the estimates are about 108 billion. So how much is that in comparison? Because that does sound like a lot of money. In 2024, different presidency, we took in a total of 77 billion. So far in 2025, we've increased our income by 40% so far, right? And we're on pace to take in more than 2 trillion. There's that 2 trillion number again. It keeps coming up, and it's important because Congress has budgeted 2 trillion more than what's currently in the budget, which doesn't make sense because the Congressional Budget Office, the CBO, is supposed to only approve budgets when there's enough money in the system. And the only reason they would approve that budget is because hidden in the data are more taxes. But then Trump tax rates or the Trump tax cuts. Trump cuts taxes. Oh my gosh, it's going to cost us this much money for that budget to work. Why? Because currently there's all that extra spending. Doge comes in, Doge starts cutting contracts. Doge starts forcing departments to honor their budgets. New department chairs or new committee chairs or new secretary, like Secretary of the Treasury, new secretaries force their departments to operate within budget. Doge's mandate was to save the United States $2 trillion in the first 2 years of existence. $2 trillion deficit, $2 trillion in savings. Problem solved. President Trump goes on global visits at renegotiating treaties, renegotiating trade, pouring money into the United States. He gets 2 trillion alone when he takes his Middle East trip. He gets this done, he gets that done, and now we have almost $2 trillion coming in by end of year just on tariff money. And what Congress is hoping is not going to happen. Congress sees it as we're spending 2 trillion, now you're saving 2 trillion somewhere else. 2 trillion in investments, all these other companies investing infrastructure projects, but USAID got cut. So those third-party contracts where Congress gets rich and we don't, those are over. And 2 trillion in tariffs sounds like a ton of money, and it is. But is it going to Congress? No. Well, where is it going? It's going into the external revenue service. So it's going around the IRS, it's going around Congress, and it is going around the Federal Reserve. Well, what would we use the money for? Because that's a lot of money. Well, if you listen to President Trump, and not the news, but if you listen to President Trump, he wants to pay down the deficit. We are $36 trillion in deficit. 2 trillion is a drop in the bucket, right? But 2 trillion over time. So you have 2 trillion in savings, 2 trillion on one business trip, 2 trillion by tariffs. That money adds up. So, and it's all different stuff. So like 2 trillion in a 2 trillion off the congressional budget, yes, is still controlled by Congress. 2 trillion invested is just investment into America plus whatever taxes those companies pay. And then you end up with 2 trillion as an outright direct deposit into the external revenue service, whose whole purpose is to collect tariff money outside of Congress and then pay down the national debt. So if that happens, and it's happening, if that happens, we'll see inflation drop further. You'll also hear more talks of certain income brackets, one, having lower taxes, and two, paying no taxes, no federal taxes. And that would be a direct counter to the IRS, be a direct counter to the Federal Reserve. The Federal Reserve has proven themselves unneeded if tariff money covers the budget or covers the bulk of the budget, then the IRS size and scope decreases as well. So on Congress's mismanaged money, because we all know they do it. I don't pick a party. Congressionals as a whole mismanage money because it's always other people's money and it's generally always somebody else's problem. That's not to say they're all complicit in the scheme, but I think there's far fewer people in Congress who are actually worried about money than what we need. We need everybody in Congress worried about spending our money and spending it appropriately and not making us pay for all the stuff that we don't need. But since Congress has become so famous at mismanaging money, cryptocurrency has been on the rise, or the cryptocurrency idea has been on the rise. And that's the current fad. I mean, if you want to push back on poor money management by a government, right, or a weakening US dollar, crypto seems to be people's best answer. President Trump just signed an executive order saying that people could now trade cryptos inside their 401ks. I think that's a pretty bold move. That's a pretty interesting move. I wonder if that same idea trickles down into Roth accounts or, 401k, but then you end up with different types of IRAs. Like, I wonder if it's a sweeping change or if it's just 401ks. It is interesting as that is, it gives me pause um, for a lot of reasons. The one service I pay for, Brett Owens has written for the last 4 years on why cryptocurrency is not needed. Yet he wrote an article recently about an ETF fund that operates, say about 50% of the fund operates on crypto futures. So the company doesn't own crypto outright. They're negotiating contracts based on people's perception of how valuable crypto will be in the future. And that's honestly, it sounds like the same, not the same. It sounds like a similar niche market to CLOs. Um, and it gives me pause. So my reasons: one, we got burned and scammed hardcore. I say we, it was me, but we got burned and scammed hardcore by a crypto trader, hardcore. Um, and I generally don't tell the story because of, quite honestly, how it makes me feel. Um, you know, as the leader of my family, I take failures very personally. I feel them deeper, especially like when I fuck up bad. I feel that, and it hits harder than a lot of other things. So it getting scammed of that nature gives me, I get it. Different people are different people. That's the Ted Lasso line, right? Like, just because one person did this doesn't mean everybody does that. Different people are different people. The crypto market is the crypto market. I've heard good things of the crypto market. I've heard some pretty dark things on the crypto market. But my reasons: one, we got burned and scammed. I got burned and scammed hardcore. Uh, Two, though I like the idea of a decentralized currency, I do see it as a pathway to a one world government. Three, it's more chaotic than the traditional stock market. Four, yes, like all investments, it comes with risk. And I mention it twice because it's that risky. And yes, there's risk reward, but I wouldn't sink my portfolio into crypto. Five, for someone who's staked a portfolio on closed end funds, it seems like base treachery to consider a crypto fund outside of the closed end fund world. One, two, three, four, five, six. Do I consider an alternative form of investment done in small $5 to $100 share quantities as being treacherous? Like, yes, we have the closed end fund portfolio that is only closed end funds. Would I consider a $50 to $100 small batch purchase? Or would I consider, probably a better question, would I consider it? I mean, it would play into my diversification goals. Um, and based on history, the fund he mentioned is uh, is BITO. I looked on Morningstar, and it's got like three or four funds inside the fund. I looked on the online investor, which had a much better dividend breakout and price scale. And I tried to search the the company that BITO is invested in, and it is all future trading. It's all projection on how people think it's going to go, like selling covered calls essentially on the it's like the stock market covered calls we've looked at, or the covered call funds we've looked at. How do you think the market's going to go? Uh, they're essentially doing the same thing, just in contract format. There we go. Um, and on Morningstar, one of the companies that BITO is invested in, it's itself, but it's a Cayman Islands based fund, so it's really hard to track. So I don't, and I like to know what's in funds. I really can't track what's in this fund. Um, So based on the history of the fund, the dividend widely fluctuates, and it's not like I can get it on discount. It's not a closed-end fund. Outside of BRW, which we own, I haven't found a fund that I'd buy that also has crypto. Now, I'm sure that BlackRock has crypto, but I'm not buying BlackRock outright. Disagree with their stance on a lot of things. But what makes BITO tempting is this: two forms. So it's currently $21.47. Has a decent track record, and it has a 68% dividend paid monthly. But it's a variable dividend. So on average, just a rough average, you're looking at, say, between January and now, it's fluctuated between, I think, a dollar and 1.2. So we're 8 months into the year. It's kind of tilted more toward 1.2. Uh, but at 1.2 off of a $21, say like 50 cent, $21, 50 cent fund, you're looking at a 68% monthly dividend on a company that doesn't own crypto outright. BRW owns crypto outright. It doesn't own crypto outright, but it essentially sells covered calls on crypto contracts that are based all in future mindset. So the 68% dividend is tempting, highly tempting, super tempting. But is that a greed-based mindset, or is it practical? And I honestly don't know. Um, I specialize in closed-end funds. like my focus has been closed-end funds for a lot of different reasons, which I've gone into on past videos: cheaper buy-in, better dividend, uh, instead of single entity risk, like you would get with a single stock, you get this portfolio of a lot of different things. Like you can buy the top 10 tech companies individually and get just shit for dividends. Or you can pick that up through a closed end fund and get it for under $10. You can get an 8 to 10% easy 8 to 10% dividend. Uh, you can get it paid monthly. Um, it just seems like a much better, you can buy it on discount. Like it's inbuilt diversification. You're not buying single fund and going through single fund risk. Um, I love the closed end fund market space, and I have like focused on that. So it's really challenging for me to think of picking up something outside of that. But knowing where the market is going, looking towards that bigger overall push into crypto, knowing the desire of a younger generation to push into crypto, it's is it worth playing into that? And I don't know. It's Substack has been warring for headspace, and now I've got this consideration warring for headspace, and I just don't know. I think no, I don't know. So I will weigh it out. I will see what I come to. I know my YouTube page has, I've changed the description where it is closed end funds, but it is also other assets. So I don't feel like it's base treachery. I do feel like I'm being honest that it's mostly closed end funds and maybe some other stuff. But at the same time, I just don't know. And this isn't like, should I, but it's not so much, should I buy this or not? Like, should I buy this or this? I need to weigh that out. It's not that. It's a much bigger societal worldwide view debate. Do we try it and see? Uh, like, do we small batch it and see? Or do I stick with what I know? And I've got to figure that out for myself. So take the info for what you will. You can search it all you want. I use Morningstar, which is free. I use the online investors, just the onlineinvestor.com, where I believe you can search for 6 different funds before it forces you to subscribe to his email service, but it's actually a pretty decent free email service. Um, but the ticker is BITO. So it'd be Bitcoin Info Tech Obsolete. Um, Yeah, check it out, see what you think, make your own call. So, on the closed end fund side of things, what's the focus? Like, where's the best place for us to be? And I still think we're in the same position with high interest rates, regardless of what you think of the Fed, with high interest rates, that's still a bond and bond proxy mindset to where that, like, our primary look is bonds and bonds proxies because in a decreasing rate environment, those prices should go up. So bonds and bond proxies. So real estate, BDCs, utilities, energy transfer, and CLOs. And the CLO fund market or the CLO market has just taken a hit and a beating. Fears of default, which the default rates are low, but you're dealing with the herd, and the herd is finicky. It really is that panic school of fish with one shark in sight. So when more sharks show up, they really just get finicky. Um, So fears of default, the CLO space just dropped. So I finally took the extra cash just hanging out in our Roth and just bought a pack, or really I bought a 200 set of OXLC. We already owned it, bought it low. It brought down our buying average, like a win-win-win. Um, so outside of bonds and bonds proxies, there's oil, which is up and down, and it all centers between Russia and Ukraine and Europe. The Middle East plays into that too. I mean, it's interesting. I don't know what gas is in your neck of the woods. Uh, Around me, Exxon is $2.47, $2.45 a gallon. And if you pick a Shell station anywhere, it's at least 20 cents higher, which is kind of interesting. Um, let's see, tech, which would be not the outright tech companies, but really anything that would do better with AI or tech. That's a good option right now. It's, I'm going to sound like a coin. A coin is not two sides, a coin is three. So bonds and bonds proxies are kind of like, so if you look at a coin, it'll land on heads the majority of the time because heads has a little more weight than tails. So the probability is higher that it lands on heads. So if we label a coin as bonds and bonds proxies as heads, then stocks would be tails. In the middle would be anything. Following a dip, almost everything does great. So even if your coin landed on the side and you just picked random funds, the odds are in your favor of picking a winner because the market dipped. Now, if you wanted to increase your odds, you would hope it landed on a side. Heads with the heavier weight because of bonds and bonds proxies. With rates high, those bonds proxies prices are down. They work inversely. So if rates drop, then bonds and bonds proxies should go up. That's what we want. We want to be there before the herd gets there because the herd's always late to the party. But if we look at tails, tails is still a good option. With money pouring into the US market through tariffs, through company investments, who was it GE? I think that just announced another $1 billion investment into the United States, moving more manufacturing, moving more production, moving more industry, moving more infrastructure, hiring more people, right? So with companies pouring money into the U.S. and tariffs being poured into the U.S., uh, you, the U.S. market is a really great place to be. And it's only going to get better because of all the money pouring into the US economy. If you factor it like we had the space race, now we've got the tech race. And it's really between us and China. Pre tariff, most companies were tracking and trending and favoring China. Since tariff, say tariff 1.0, Liberation Day, but now tariff 2.0 in August, but you have companies moving their focus to the United States and looking to the United States to lead. As more companies choose the United States, more countries choose the United States over China, President Trump is pushing us toward the next technological advancement ahead of China. And that's good, right? That's great because that pushes the US to the forefront of things. We want to be the dominant economy. We want to be the place everybody wants to be because it gives us more leverage against everybody else. So, with more companies and countries siding with the United States, that's great. That means that shift should mean that US companies should go up in value, right? And I say should because it's a market. The market should do a lot of things, but it doesn't always. It goes back to the toddler, right? Sometimes it's fine, sometimes it slips and falls, and sometimes it dings its head on a door and just smashes to the floor. Then it gets back up and keeps going, right? So if you're going to invest in stocks, now seems like a great time. I still think it's more bond proxy favor, but if you find a great deal on the stock end of things, I think that's a great idea too. And on my end of things, I specialize in closed-end funds, and BITO, that ETF doesn't fit into that ideology. But what does is the dividend. Because the whole point, the guise of our mindset, or maybe not the guys. I don't want to make it sound like a diss, guys. The strategy to the portfolio is that we're building a no withdrawal portfolio. Now, that doesn't mean we can't buy and sell. Like there are things earmarked in our portfolio for sell, but it's not like we're going to take the money out. The goal is to sell it and then push the money forward into better investments. So we want a no withdrawal portfolio, something that if you look at the market as a whole, whether you've been in the market a day or 40 years, you know that it looks like this if you stand back and look at it from far away. But if you break it out into day to day, it's not like a flat line. It does this all the time. Sometimes it goes crazy high and sometimes it goes crazy low. Regardless of portfolio value, we want the dividends, right? So knowing that the market's going to do this, we want a dividend-based portfolio that's going to pay when it's like this and pay when it's like this. So in building a no withdrawal portfolio, we want our principal to increase. But we also know there'll be great days and we know there'll be bad days. We want the dividends. So even, gosh, in closed-end funds, like everything I already said, discount, buy-in, dividends, inbuilt diversification, right? Multiple fund investment outside of single stock investment. All of that plays into our strategy. And buying an ETF, yes, they're all exchange traded funds, but buying an outright ETF and not a closed end fund feels off. But it's the dividend. I don't know if it's everything else. You look at that portfolio and you look at the stock value and you'll see that it goes up and down like everything else. And they do have a varying dividend. But I guess my argument is this. So if you buy it tomorrow at $21.47 and you got $1 per share, so you buy 100 shares, well, that's $100. So 100 divided by, let's see, I'll pop up this metric uh, from Brett Owen's free service, but $100 dividend divided by your buy-in price. Uh, let's see. So $100 a month is 1,200 a year divided by that buy-in price is a 56% dividend. So that's really hard to look past. And I don't think I would think like I would not put everything into crypto because it changes too much. But that's kind of like that's the argument inside my head of like I've preached closed-end funds, but now I feel weird saying this is a this is something that's like percolating inside my head looking at. Like I've preached closed-end funds, and now it's like I wonder if this is a good idea. It just feels off to me, but that doesn't mean it's not a good thing. Um, so here, I will bring up the the closed-end fund portfolio, but I'll also share this other thing that I found today, and then we'll get in the portfolio. So, man, that's I don't know if y'all can see that, but that's really annoying on my end. There we go. So freeze frame it and read this for yourself. All right. But Brett Owens released a free article. So if you Google search or meta search or whatever you're using, uh, if you search for Brett Owens BITO article, this is sure to pop up. So it's not like I'm sharing member only format stuff. Uh, this is like, yes, it's a variable dividend, but currently at $1.20 a share at the current buy price puts you close to a 68% dividend. That's pretty freaking amazing. And even at its worst, I mean, I took it from a dollar perspective, 20 cents less. Um, that's still pretty amazing. So Will I consider it? Yes. Do I have an answer on yes or no? Like, will I consider it? Yes, because we are built for other assets, but I just got to think about it more. So, based on what I normally talk about, this is our portfolio, but it's not completely accurate. I noticed today there are two funds missing. So, and I haven't made the video of why we bought those funds. So I owe you a different video. But this is what we bought last time. We bought, I guess, maybe 2 weeks ago now. I left off these two funds because I figured, hey, it'd be a great opportunity to demo the idea. These are crossed off simply because they're in the portfolio. Um, or like I've updated the portfolio around the buy. But I left those off because it was like, hey, it'd be a great opportunity to show, like, make a how-to video of how to build or how to update your portfolio and how to do the dividend side of things. And then I got reminded of that today that it was more like, crap, I haven't done that yet. So on the master list itself, I updated the color-coded stuff. Everything in green and purple got an update today. The earmarks over here are the color code for that's cash-based account or cash-based brokerage account, and R is for Roth. We already own those. So if I take the top, or if I take the triple asterisks and the dollar cost average buys, and then I drop them here, now we start sorting. Now they're triple asterisks because the existing discount meets our standard of the existing discount is double the historical value and greater than the 5-year value. And for newer funds, the existing discount is competing with the newer data. Like if the fund's been around for 3 years, I'm not going to look at historical data. I'm just going to look at 3-year data. Or I guess I am going to look at historical data, but it doesn't have 20-year data. Maybe that's a better way to put it. So we end up with this list of triple asterisks, which is lengthier than it has been, mostly because I finally got to dig into the closed-end fund master. And then we also end up with these dollar cost funds or dollar cost average funds. Um, and ASG no longer fits the dollar cost average because it's price change. Municipal bonds, I think, are still great buys. It's there is debate, and there's enough on one side and enough on the other side to keep me in the middle. Um, if if the short term rate drops, would it impact like money market accounts? Like the current money market account, like general account at Fidelity is 4%. So if the short term rate, the Fed rate dropped, would the money market interest account drop as well, or interest value drop as well? And would that also impact long term rates or the long term rates housed inside municipal bonds? Some people say yes, the rates would go down. Some people say no, no change needed. So it's more of a cautionary tale for us since we already own the funds. If and I've seen these as higher. I mean, we've bought them lower. Uh, for us right now, just based on discount, they're not great buys. But for us, based on prices, they're all about a 1% down overall inside our portfolio. So they are dollar cost average buys, but they're not great buys. ZTR is on the sell list. Um, Buying it now would be cheaper than our current average price, but at the same time, I really don't want to buy more of it. I don't want to own more of it. Now, getting into the list itself, the easiest way to focus is to make it based on, and that's interesting how that one came out still on top. That's crazy. If I sort A to Z, there we go. So healthcare in general, healthcare, I'm not a fan of. I don't know about I don't know enough about this one to comment. This one, if you're looking for, so it sells covered calls. It does well in high volatility. So it's a great pickup in low volatility because it's not as popular. I am not a huge Aberdeen fan. Uh, we have, we've owned several Aberdeen funds. I'm just not thrilled with how they were managed. Um, and USA is one of we own four tech-based, US stock-based blue chip powerhouse funds. USA, ASG, ADX all pay quarterly to a degree. They pay once a quarter, yes, but it's not an outright category in the sense of category one would be paying the first month of the quarter, 14710. Category two, 25811. Category three, 36912. They all pay quarterly, but they all pay on an alternate schedule. USA and ASG are sister funds. They pay 1369. If they pay a special dividend, they pay it in January. The ex-dividend date is in November or before January. ADX pays it pays 25. I'm going to say 25812. There we go. And they typically pay special dividends in December. And then NBXG is a 5G fund or like a 5G tech fund. Um, and they pay monthly dividends. Stock, I like monthly dividends. I love monthly dividends because they're so easy to track. It's so easy to anticipate what's in your bank account if you're withdrawing. It's just nice. But not every stock fund comes in monthly payments. So it's easy to find bond funds that are monthly payers. It's harder to find stock funds, good stock funds that are monthly payers. So since we just bought, we're not buying that stuff. So we end up with all monthly payers. Now, that being said, we're not buying, but of what I would keep on the list, I would keep USA on the possibilities list. So, and it goes back to if we're buying or we are, like we're buying, here's what I'm looking at. But in this case, we're not buying, but I can still leave it on the list of possibilities. So then we come down to what the yields are. I like 9% yields or better, unless there's a good reason to look at something different, which HFRO is that. NDMO is a municipal bond. It's going to pay a higher tax equivalent dividend, but we already own municipal bonds. I don't want to add more. I mean, it's a Nuveen fund, but we already own three Nuveen municipal bond accounts. So it just seems overkill to add another one. Uh, Saba was all government and derivative. DNP just pays a knockout consistent dividend. Here, HFRO, we'll do that first. The dividend has decreased because the price has increased and the overall dividend has stayed the same. It's a real estate fund. And I've said it in weeks past, like really the last year probably of making videos. I think the fears around the fund are overkill. Um, I think there's a lot of promise in the fund. So I've kept it. And it's still the biggest discount. So I think it's worth being on the list. TNP, uh, you can you can determine if 519 and 470 are close. I think they're close. It's close enough so it stayed on the list. So we have real estate, bond proxy, real estate, bond proxy, utilities. Let's see, municipal fund. Municipal fund mixed, so it's not completely tax-free. ERH is utilities, but they pay a very inconsistent dividend. And we've owned all spring funds in the past, and I'm not a huge all spring fan. NBXG is one of our tech funds. It's higher priced than it has been. The dividend has lowered because it's done well, but it's still discounted decently. I've talked at length about Eaton Vance and Calamos compared to the tech funds we bought, and it really does depend on your perspective. These funds have billions in investment, as do a lot of other companies. I picked NBXG, ADX, USA, and ASG because they don't have hundreds of companies and like they're not invested into hundreds of different companies. It's very targeted investment. And I like that. It's diversification, but at the same time, it's laser focused diversification. We're going to go with this stuff versus even though these have been on my hit list a while, especially the covered call funds. But if I'm looking, I mean, they're all similarly invested, I guess you could say. But if your portfolio is 600 invested funds compared to 100, I kind of like the 100 because it's a much narrower focus and it says that you're not looking into all this other stuff. RLTY, it is straight real estate, except it's different than actual houses. Like HFRO is healthcare space, housing space, leased housing space. RLTY is business leases. We already own RFI, same company, but it generally sits in premium. So when RFI is at discount, regardless of the discount, it's a great pickup for us. But that also means the majority of the year that it's in premium and we're not buying it. So if we wanted to stick with the same company and invest slightly differently, still mostly the same stuff. But if we wanted, if we like, and I like Cohen and Steers. Uh, if we wanted a similar investment, we would pick that. That being said, it's 15 bucks a share and it pays a consistent dividend, but it's not a 9% dividend. Um, TEEF, solar seems to be popular now. It is not, and I'm a solar fan when it's needed. I don't like the mandate to use solar. I mean, this company essentially hate, and they say it on their website, they hate oil. They don't say it that way, but they hate oil and they love all this other stuff. But it seems kind of duplicitous because in order to make their product, it requires oil. So it doesn't really make sense. DLY is a great bond fund. We own the sister fund. They are structured differently. I checked into that. They are structured differently. Um, so it's a good option, but at the same time, it's not a good option for us because we're already heavily invested in the bonds. And even though it does give us a different angle into the bond sector, it's also $15 over $15 a share. But I'll leave it on the list. CIF is in the Roth. On that pendulum of price, CIF is a roller coaster ride. And having ridden the roller coaster on different funds, ZTR, CIF, and others, that roller coaster ride does not go how it sounds it'll go every single time. CIF, we're hoping that when rates decrease, CIF increases in value. That's its history, but we'll see what happens this time. But I'm not buying it again. FTHY, I don't know enough about. There's still just a lot I don't have. I like we have funds that are invested into banks, but Fins is heavily invested into banks. What does my ear tag say? Yeah, but still, it's heavily invested into banks, which may or may not be it. It might be a great idea with the BDC idea in this current presidency. But if the Fed's about to cut rates, I don't know how good of an investment is long term. That makes sense. Like, think of how to say this. Yes, it's always better before the herd. We're heavily invested into bonds. We've got kind of a bank angle through other things, but not quite that level of bank angle. But I still I don't know enough about the fund. I'll leave it at that. RA is all bonds, and we've already got a ton of bond funds. PDO is name, it would be name recognition, but it's another bond fund. It's the same idea. You want to buy it when it's close to the 52-week average. So at 4.4, 3.9 is close. Even though it's at premium, it's still on discount for the fund. Uh, let's see, stocks to bonds, but with foreign investments. CLO, I talked about at length last week. I went with the CLO that we already have and that has been in the game the longest. Excuse me. So where all these other CLO companies are interesting, I just went with OXLC. Aberdeen, not a fan of. HGLB has some stuff in their portfolio I'm not sold on. I mean, I liked their portfolio. I loved it when it was very specified. I really did. And it still is specified to a degree. Um, it's it it's not bad, but it is still more widespread out than it used to be. Hicks doesn't do better than the broad market. I am not a BlackRock fan. Um, yeah, the next three are CLO funds, but OXLC has been in the game longest and to me has been the best opportunity or best option for us. So if we backtrack and look at what's on the list right now, we compare it to the focus, which is really everything. Which you have bonds and bonds proxies, US stocks, oil, which none of these has a direct play into oil, if you want to count utilities. Um, yeah, and crypto, BRW has crypto and it's actual crypto and not futures crypto. So you end up with bonds and bonds proxies, bonds, but also some other stuff. Um, bonds, closed-end funds, crypto, bonds, stocks, bonds, real estate, 5G tech, utilities, and then real estate. So, and it, nor say if it's a buying week, it's like, here's what I would buy. Like, go from Sunday night looking into Monday. This is what we're going to buy. And I earmark those. But in the weeks that we're not buying, it's more of an open strategy session, I guess you could say, of yes, we're not buying. Here's what I would pick and why. But it really is an open-ended list because it still depends on you, your strategy, your portfolio, and where you think the market's going. If you're not invested in any of these funds, then in your head, you have to weigh out the option of adding a new fund. Like if I'm going to pick up something new, in other words, if it doesn't have these color codes in it, if I'm going to pick up something new, is it worth what I'm investing in? And yes, it's worth it. But at the same time, is it better than what I already have? Like, I don't want to buy just to buy. I want to buy on strategy. Show me something that is better than what I don't already have versus, I mean, what I do already have. Yeah. Then if it's better, then it's a great buy, especially if you can get it on discount with the dividend and the monthly supply, all that stuff, right? If it's not better than what I have, then I don't want to buy. Like, I don't want to force buy. I don't want to pick up anything that's worse than what I already have. That doesn't make sense. So compare it to your own, my advice. And I'll reiterate, I'm not a financial advisor. I am not a financial advisor. I'm a strategist. I'm a financial strategist. It's look at your portfolio, see what makes sense, see where the market is now, scoop deals with a forward or a future based perspective because the market does look forward. And I get it's crazy right now, or maybe it doesn't. When you're not worried about the day to day value of your portfolio, your stress level goes way down. So if I'm looking at a future based portfolio in the sense of I'm building a no withdrawal portfolio, for dividends that I will reap later or withdraw later, a lot of my stress goes away because I'm not worried about the current value of the market. One, and two, I know the market's going to go up and down. And three, it should, in quotes, be higher than what if I have to sell. But it's all based on the current market. So almost everything right now is a great deal because we just had a dip. But looking forward, I mean the oil pattern is cyclical. At some point, oil will reach its peak again, and we'll have to make a choice on what to keep and sell. Yeah, I said that right. On what to keep and what to sell. And then we'll push the money forward. When the bond market shifts, and I won't say if, whether Jay Powell cuts rates or somebody else does, when the bond market shifts, we'll have to make that choice. Do we want to keep these funds? Because at some point, like should we sell them high and buy them low? Or should we just ride it out and collect the dividend all the way? Right. So it's always evaluating the current situation with a forward based look. You learn what you can from the past and you push that ahead and apply it to the future. That's adaptive perspective in general. So it's play the current market, scoop the best deal with a forward thinking mindset. And the best thing right now is bonds and bonds proxies, but close behind is the tail end of that coin with US stocks. And even if it landed on edge, you could pick anything and the odds would still be in your favor of picking a winner. Now, it might not win as much as a US stock and it might not win as much as a bond, but it would still win. So look at your strategy. And if you don't have one and you're just willy nilly investing, you got to pick up a strategy. Look at your strategy, define your strategy, see where the best place for you to invest is. And then if you think that's bonds, bonds proxies, stocks, or something else entirely, then stick with that. And if the option comes to change or someone floats an idea by you, then consider it and see how that weighs on you. See what makes sense to you and do the best thing for you. For us, we are not investing tomorrow. If we were, I would curtail this list more thoroughly, or I would shrink this list considerably because more money spread out, it's more money spread out is diversification, but it also limits your growth, right? It's butter scraped over too much bread. Some of that bread will not have butter. Some of that bread will not have enough butter. Some of it will be heavy handed. It doesn't allow you to grow in every area. Right? If you had 100 grand to invest in every month, yeah, you could invest in a lot of different stuff, but that's not most of us. If you've got 5 grand to invest, think of it like if you've got 10 products and 5 grand, that's not much into everything. So based on your money, do the best things for you, even if that's picking up one fund, right? Because that's still just more shares than what you already own. So define your strategy, see what makes sense to you, see what fits into your portfolio. Is it better than what you already have? Are you getting something at a great deal? Does it make sense moving forward? And then buy based on your strategy. So that's really all I got. I mean, I could keep saying the same things and I could keep browbeating the same topics, but that's all I got. I've got stuff to figure out on my end. I've got Substack to figure out. I've got BITO, whatever the pronunciation of that acronym is. But I've got Substack to figure out. I've got BITO to figure out. And then I've still got more work to do in the closed-end fund master, and I've still got more portfolio update to do. Let's see. So if you like the content, consider subscribing to my channel, and then help me hack YouTube. Leave a comment, share the video, like the video, smash the like video, but help me hack YouTube. One, yes, because I want to grow my channel, but two, equally, and I wouldn't put them on a scale. I wouldn't be like 50 this, 50 that. No, in equal measure, I want to help more people. So YouTube shares videos based on popularity. So if you comment, or share it or like it, it tells YouTube that more people need to see it, and it will push the video out further. So if you like my content, please leave me a comment, talk about whatever you want. Talk about what you're buying, what you like about closed-end funds, give me your take on ETFs, anything in the world, whatever you like. If you want more if you want more info on the overall 12 steps, whatever you want to talk about, but then share the video and like it and help me hack YouTube. So if you want to find me day to day, leave a comment for now. But if I actually get Substack built out, you'll have a day-to-day chat option. And then let's see what else. Really, there we go. My video paused for a moment. I got really worried. Um, I've got work to do on my end. You have work to do on your end. Whatever your week holds for you, I hope you make progress. And whatever that is, like a half step forward is still more steps than standing still. So whatever you have for the week, I hope you gain some ground because I've got ground to gain. We'll see how much I get, or say we'll see how much farther along I am next weekend. So, but again, whatever you have, I hope you make progress. And then again, I wish you well in all your endeavors. So have a great week, everybody. I will see y'all on another video. Bye-bye.